Welcome to today's discussion. We're diving into the world of business development companies, or BDCs, and exploring their potential for growth and income. It's a fascinating area, and our guest is here to shed light on this often overlooked investment strategy.
BDCs offer a unique blend of income generation and growth potential, often exceeding traditional fixed income options. They provide access to a segment of the market not typically available to individual investors.
That's intriguing. Many investors are familiar with stocks and bonds, but BDCs are less common. What exactly are they?
Essentially, BDCs are companies that invest in private and sometimes thinly traded public companies, primarily through debt instruments. Think of them as specialized lenders to smaller businesses.
So they're like a bridge between private equity and traditional lending? Let's delve deeper into the mechanics of BDCs. The paper highlights their investment strategy. Can you elaborate on the types of companies they invest in and the associated risks?
BDCs primarily lend to and invest in private companies, often those rated below investment grade or unrated. This exposure to private credit offers potentially higher returns but also carries higher risk. These companies are less mature and smaller, inherently riskier than established public companies. There's also the risk of default or bankruptcy. Information on these private companies is often limited, making informed investment decisions more challenging.
That's a crucial point. The lack of transparency is a significant risk factor. How do regulations mitigate these risks?
BDCs are regulated investment companies, REIs, subject to strict diversification and leverage requirements. They can invest more than 25% of their assets in a single investment, and over 50% must be in investments representing less than 5% of assets individually. This diversification helps spread risk. Additionally, their debt-to-equity ratio is capped at 2:1, limiting excessive risk-taking.
So the regulations act as a safety net, preventing overconcentration and excessive leverage. But what about the income potential? The paper mentions attractive yield characteristics.
The attractive yield stems from their investment portfolio and their RIC structure. As RICs, they're required to distribute at least 90% of their net investment income to shareholders, leading to potentially high dividend payouts. Historically, BDCs have exhibited yields significantly higher than many other asset classes, as shown in the provided chart.
That high yield is certainly appealing. The paper mentions the VanEck BDC Income ETF, BIZD, as a way to gain exposure to this asset class. What are the advantages of investing through an ETF like BIZD?
An ETF like BIZD offers diversification across multiple BDCs, reducing the risk associated with investing in a single BDC. It provides convenient access to this asset class for individual investors who might not have the resources or expertise to invest directly in individual BDCs. It also offers professional management and streamlined administration.
The paper also provides performance data for BIZD, comparing it to other asset classes. What insights can we glean from that data?
The performance data shows BIZD's total return over various periods, highlighting its historical performance relative to benchmarks like the MBIS U.S. Business Development Companies Index, MBBTCTRG, U.S. high-yield bonds, and other asset classes. However, past performance is not indicative of future results. It's essential to remember that BDC investments carry inherent risks.
Absolutely. It's crucial to understand the risks involved. The paper lists several risks associated with investing in BDCs and BDC ETFs. Can you summarize those key risks?
Investing in BDCs involves several risks, including the risk of default by the underlying companies, the lack of transparency in private company investments, the potential for high volatility, and the impact of interest rate changes. The ETF itself also carries risks related to index tracking, liquidity, and management fees. It's vital for investors to carefully consider these risks before investing.
So a thorough understanding of the risks is paramount before considering this investment strategy. What are your final thoughts on BDCs as an investment option?
BDCs offer a compelling blend of income and growth potential, but they are not without risk. Careful consideration of the risks and a diversified investment strategy are crucial. For investors seeking higher yields and exposure to private credit, BDCs accessed through an ETF like BIZD can be a valuable addition to a well-diversified portfolio. However, it's essential to conduct thorough research and understand the inherent risks before investing.
Excellent points. Thank you for this insightful discussion.